LVMH H1 2025 Earnings Preview, What Investors Need to Know. LVMH's H1 2025 earnings could be a game-changer for luxury retailers. The world's largest luxury goods group, LVMH, will unveil its first-half 2025 results on July 24, following the Euronext Paris closing. As the top player in luxury goods sales, €84.7 billion in 2024, investors are closely watching how executives gauge the health of American, Chinese, and European consumers, key drivers of LVMH's revenue. This year's earnings will be even more scrutinized as LVMH stock has underperformed the Morningstar Global Luxury Goods Index, which fell 7% since January, compared to the broader market's 22% drop. Analysts will dissect the outlook for the fashion, leather goods, and wines divisions, which account for 48% of sales and 78% of recurring income in 2024. But here's where it gets controversial. While LVMH's margins are expected to remain under pressure, the most profitable segments, fashion, leather goods, and sports, are facing the toughest sales declines. This could strain profit margins, compounded by fixed cost leverage. The FactSet consensus predicts €39.89 billion in first-half sales, down 3% organically, while operating income before non-recurring items is projected to rise to €9 billion from €10.65 billion in 2024. And this is the part most people miss. The luxury group's net income is forecast to hit €5.9 billion, up from €7.3 billion in 2024. Investors will focus on the fashion and leather goods division's commercial momentum, which contributed 48% of sales and 78% of recurring income. However, trade wars and currency trends, particularly the dollar's depreciation, pose risks, as noted by Santander analysts who warned of macroeconomic uncertainty threatening growth in Q2 2025. The health of the Chinese consumer remains a critical factor for LVMH, as cross-border sales in Japan, where Chinese tourists are a major draw, have outpaced mainland China. Meanwhile, trade tensions between Europe, the US, and China are impacting champagne and cognac demand, with Hennessy, LVMH's leading cognac brand, directly tied to global trade policies. Estimated fair value LVMH's fair value was reduced to €620 per share from €650 in April, reflecting a more challenging macroeconomic environment. We expect the leather goods division to grow 6% annually, with margins hitting 40%, 39.9% in 2022, driven by LVMH's global brand appeal and pricing power. Louis Vuitton, the #1 luxury leather goods brand by revenue, is poised to outperform rivals in sales growth, with targets of 5 to 10% due to its status as a status symbol. Economic moat rating LVMH's strong brand equity and pricing power give it a wide moat. While gross margins are hard to judge due to its diverse business mix, the fashion and leather goods division's 40% operating margin, on par with peers, suggests robust profitability. Louis Vuitton's operating margin has historically hovered around 40%, fueled by pricing and scale, over €20 billion in sales, now potentially nearing 50%. The brand's ability to raise prices in 2009 and 2020 to counter declining footfall underscores its pricing strength, which is especially pronounced in its luxury leather goods segment. Financial strength LVMH maintains a net debt-to-EBITDA ratio of 1x, indicating solid financial positioning. Its diversified business model, with recurring revenue from consumer products, reduces sensitivity to economic downturns. Operating cash flow is expected to remain stable, with over €10 billion in annual cash flow to fund expansion and capital expenditures, 5 to 6% of sales, focused on younger brands and production upgrades. Risk and uncertainty LVMH is rated medium on Morningstar's uncertainty scale. While the luxury industry thrives on economic growth, structural slowdowns pose risks, especially with slower luxury demand and a challenging comparison base. Although LVMH's M&A success is notable, overpaying or selecting poor targets remains a concern. Currency fluctuations, though manageable historically, could complicate pricing strategies as demand weakens. The author does not own shares in any securities mentioned in this article. What's ailing Louis Vuitton? LVMH faces luxury slowdown and market shifts. This week, what's troubling Louis Vuitton? What's the scoop? The luxury market is facing significant struggles, with LVMH, a leading player in the sector, anticipated to announce a decline of over 10% in its fashion and leather goods division during its quarterly sales and first-half profits report set for July 24. Is bigger still beneficial? In past slowdowns such as the 2008 financial crisis and the COVID-19 pandemic, LVMH's gigantic scale and diverse portfolio allowed it to fare better and rebound quicker than its competitors. However, this time around, firms like jeweler-centered Richemont, independent powerhouse Hermès, and smaller brands including Prada, Moncler, Zegna, and Brunello Cucinelli have showcased more resilience, while LVMH struggles intensify. One major factor contributing to this downturn is the unjustified increase in prices, termed greedflation, especially noticeable in their handbag segment. Additionally, LVMH is grappling with a generational transition among its leadership. Despite boasting unmatched marketing budgets and influence over retailers, the luxury landscape's rapid evolution has given more targeted companies an edge in swift decision-making and execution. As we look to the upcoming quarters, it will be intriguing to see whether LVMH's present decline is merely a temporary setback or indicative of a significant shift in the market. Zooming in on Vuitton, LVMH faces difficulties across its diverse units, from job cuts at Moët Hennessy to dwindling sales at Dior and mediocre performance at its duty-free retailer DFS. However, with a designer shift at Dior and new management at Moët, these ongoing changes are increasingly viewed by investors as issues of the past. Revitalizing Louis Vuitton, the group's largest and most lucrative brand, has become a pressing focus. HSBC analyst Erwin Rambourg noted last month, as the world's preeminent luxury brand, more than half of the group's earnings before interest and taxes seems to be at a pivotal juncture. The brand's aspirational image is currently not advantageous. The mixed messaging, from lower-end products like chocolates and beauty items to exclusive high-end leather collections, raises critical questions. What is Louis Vuitton's true identity? Who exactly is its target market? What distinguishes it from competitors? The establishment of a new deputy CEO role, with former Loro Piana head Damien Bertrand joining in March to assist CEO Pietro Beccari, was seen by Rambourg as a troubling sign, hinting at challenges surrounding the brand. Striking a balance between diverse themes, which include high visibility and refined elegance, as well as premium and aspirational price points, along with core offerings and brand extensions, has long been integral to the strategy of this mega-brand. However, if another quarter passes with market share loss to competitors like Hermès and Prada, something analysts are currently predicting, investors will undoubtedly question, what's the strategic direction here? We want to hear your thoughts. Whether you have tips, suggestions, feedback, or praise, feel free to reach out to brian.baskin@businessofashion.com. Disclosure: LVMH is among a collective of investors that maintain a minority stake in the business of fashion. All investors are bound by shareholder agreements guaranteeing complete editorial autonomy for both. LVMH stock analysis, ownership structure and investment insights. Imagine this scenario: LVMH Moët Hennessy, Louis Vuitton Société Européenne, EPA, MC, saw its stock price dip by 3.1% last week. For private companies with significant stakes in the company, this drop likely came as a surprise and perhaps even disappointment. But here's where it gets intriguing: these private companies have a substantial influence over the company's direction and strategy. Let's dive deeper into the ownership structure of LVMH Moët Hennessy, Louis Vuitton Société Européenne. A whopping 49% of the company is owned by private companies, giving them the most significant say in how the business is run. To put it simply, they have the most to gain, or lose, from the company's performance. When the market capitalization dropped to €236 billion, it was these private stakeholders who felt the brunt of the financial impact. Now, let's explore the various types of shareholders and what they reveal about the company's dynamics. Institutional investors, for example, hold an 18% stake. These institutions often include pension funds and mutual funds, and they play a crucial role in providing stability and credibility to the stock. However, it's essential to remember that even institutions can be wrong. When multiple institutions invest in a single stock, there's always the risk of a crowded trade, where a sudden downturn can lead to a rush of selling. Interestingly, LVMH Moët Hennessy, Louis Vuitton Société Européenne has two major shareholders with a combined 50% ownership. This concentration of power can be both advantageous and risky, depending on how effectively these shareholders work together. The general public also plays a role, holding a 32% stake. Although their individual influence might be limited, collectively they can still shape company policies and decisions. But here's the part most people miss: insiders, including board members and executives, own less than 1% of the stock. This relatively low percentage might seem surprising given their high-level positions, but it's not uncommon in large corporations. So, what does all this mean for LVMH Moët Hennessy, Louis Vuitton Société Européenne? Understanding the ownership structure provides valuable insights into who holds the real power and how decisions are made. However, it's just one piece of the puzzle. Other factors, such as financial performance and industry trends, also play crucial roles in determining the company's future. If you're considering investing in LVMH Moët Hennessy, Louis Vuitton Société Européenne, it's worth keeping an eye on these ownership dynamics and seeking out expert analysis to guide your decision-making process. By the way, if you're curious about emerging technologies like quantum computing, check out these 20 stocks that are paving the way for this revolutionary field. Remember, investing always involves risks, and past performance is not indicative of future results. Always do your due diligence before making any investment decisions.